Welcome to Money Making Minds YouTube channel. Today we're taking a necessary, almost clinical deep dive into the foundational, unchanging truths of speculation. We're here to confront a statistic that it seems to defy modern technology and all the information we have now. The infamous 90% rule.
Yes, the 90% rule basically says, right, that 90% of people who try their hand at trading or speculating in the markets, they lose their capital, they eventually just exit the game completely.
90%.
And that percentage, it's been remarkably stable for, well, over a century. It really suggests that the market's main job isn't rewarding genius.
No. What is it then?
It's more about exposing, systemic errors in how people approach it and their methodology.
A 90% failure rate, that's not just bad luck. It really points to some kind of fundamental misunderstanding of the rules of engagement, doesn't it?
Absolutely.
So if this arena stays so brutal, what's the core shared misbelief? What is it that guides so many people toward, frankly, financial ruin?
I think the foundational error really is confusing speculation with, say, entertainment. Or even worse, treating it like a lottery ticket.
Like a get-rich-quick scheme.
Exactly. People come to the market like moths to a flame, right? Believing they can get rich quickly. They open an account, maybe see some flashy stuff online, and expect instant gratification. They just fail to grasp the brutal, timeless truth. The market is totally impersonal. It's a machine.
It doesn't care about you.
Not at all. It doesn't know you, doesn't care about your dreams or your bills or your desperate need for quick cash.
Wow, that sets a profoundly stark tone. So our mission today, it's clearly not about finding some magic indicator or secret system.
No, not at all.
It sounds like it's more about understanding the internal disciplines and the external ones too that you need just to survive. It sounds less like finance and more like a test of character.
That's a great way to put it. Precisely. We're framing this whole discussion around human nature, really, and decision-making under high-stakes, intense pressure. The core premise you absolutely have to accept is that success in speculation. It isn't about how often you're right.
Okay, so what is it about?
It's about your ability to manage catastrophic risk. It's about survival, ensuring you live to trade another day. The market's tuition, as they say, is excruciatingly expensive.
Right. Market tuition. Let's unpack that idea of survival then. If 90% are wiped out, you really can't call this a fair game, can you? You called speculation a game earlier. What kind of contest is it? And what are the prerequisites even just to enter?
Well, it is the most challenging game, I think, and maybe the most fascinating in the world precisely because it's perfectly impartial.
Impartial? How so?
The market doesn't actively cheat you, right? But it punishes inherent human flaws like impatience, fear, greed with immediate and sometimes severe consequences. It's definitely not a game for the stupid or the mentally lazy. But most critically, it absolutely rejects the person of inferior emotional balance.
Emotional balance, meaning?
Meaning, if you cannot maintain ironclad discipline when your own money is on the line, you've basically already guaranteed your failure before you even start.
That idea, emotional balance, it implies a long period of training, right? Which brings us back to that astronomical market tuition you mentioned. What specific painful lessons are we talking about here? The kind that cost people their entire accounts?
Oh, the lessons are varied, but they all share one characteristic. They're only truly internalized, truly learned when they cost you real capital.
Like what? Give me an example.
Okay, take understanding liquidity. The fact that you can't always get out of a position exactly when you want to. You might only really learn that lesson when, say, a big news event causes a massive price gap and your planned stop-loss order gets blown right past. Suddenly, you've lost way more than you intended.
Ouch. Okay.
Or the lesson of correlation risk. Thinking you're diversified because you hold two different tech stocks or maybe two different currency pairs.
But they move together anyway.
Exactly. And then a crisis hits, and you realize they offered basically zero diversification. They both canked together. That lesson often comes with a hefty price tag.
And if you haven't learned to manage your position size correctly before that lesson hits, that one event could wipe you out. Meaning, you've paid the tuition fee, but you've failed the course. You didn't graduate.
That's it. Precisely. Most people simply cannot afford to stay in the school long enough to actually apply the wisdom they paid so dearly for. They take a major loss, maybe one that was actually necessary for them to finally internalize a key risk control mechanism, but that loss is so big it liquidates their account.
So they get the lesson, but it's too late.
Too late. They finally understand, maybe deeply, the profound necessity of patience or position sizing or cutting losses. but they no longer have the capital one way. They can't execute the strategy they just learned.
And that inability to learn because your capital's gone, that seems compounded by what you called the failure loop, this problem of selective memory and always chasing quick money.
Ah, selective memory. Yeah, that's a psychological killer in this environment. It really is. The beginner trader, they don't really internalize risk. They almost exclusively visualize the reward.
Right. They see the big potential win.
Exactly. They see a currency pair move, say, 200 pips in one day, and they immediately do the math. Wow, if I just put like 50% of my account on that, I'd have doubled my money.
Yeah.
They notice every single massive winner they could have theoretically captured, but they completely block out or rationalize away the dozens of small or medium losses they actually took last week, or the 3 times they got stopped out for a small loss just before a big move happened in their favor.
So they end up building this completely false narrative of their own competence, based purely on potential, not on the actual messy reality of their trading. Can you give an example of how that selective memory leads directly to ruin?
Sure. Imagine a trader, fairly new, has 10 small losses. Let's say they total maybe 5% of their account. They don't feel those losses too much individually, right?
Okay. Manageable.
Then maybe they take one lucky shot. A really high-risk bet, maybe 50% of their remaining capital, on some obscure stock or crypto that suddenly spikes, doubles their position. They book that win.
Feels amazing, I bet.
Of course. And now their internal narrative instantly shifts. It goes from, okay, I'm learning, taking some hits, to, wow, I'm actually a genius. I've got this figured out.
Yeah, they completely ignore the underlying risk structure that made that win essentially a fluke, a lucky outlier. Their confidence now massively inflated based on one lucky outcome that papers over 10 previous errors, pushes them to risk, say, 75% of their new larger capital base on the very next trade. They think they found a system.
And then the inevitable happens. The inevitable loss comes. Because the market always reverts, right? That loss liquidates them or cripples them. And who do they blame?
Not themselves, probably. The market. Bad luck.
Exactly. They blame the market, maybe manipulation, bad luck, anything but their own inflated ego, which was built entirely on selective recall.
And all the while, the market just remains utterly impartial to that self-deception. So the really foundational shift we have to make, it's abandoning the chase for the high score. For the big win.
Absolutely. That is the crucial distinction. The core goal cannot be, how much do I make when I'm right? That's fundamentally a gambler's metric.
Okay, so what's the professional speculator's metric?
The professional metric is, how much capital do I keep when I am inevitably wrong? Because you will be wrong. When you truly internalize that loss minimization is the primary goal, not profit maximization on any single trade. That's when you graduate. You move from gambling to calculated speculation.
That transition leads us perfectly into the mathematical killers. The 2 fatal errors that seem to ensure that 90% failure rate, almost regardless of how good someone's market analysis might be. Let's start with fatal error number 1, over-risking capital.
Right. This error, this is a fundamental difference between trading as a business and just outright betting. Gambling, in this context, simply means risking a material amount of your total capital on any single uncertain idea.
And what's material?
Well, we see new entrants doing it all the time, risking 10%, 20%, sometimes even 50% or more of their entire account equity on just one position, one trade. They're not really speculating at that point. They're using leverage primarily to accelerate their path to zero. The historical trajectory for those who constantly bet the farm like that is always the same. They get wiped out. It's just a matter of time.
So if that's gambling, what's the simple rule? The one that's maybe consistently ignored, but essential for professional speculation regarding how much capital to risk.
The simple rule, and it really took decades, maybe centuries of market history to cement this.
Yeah.
It's risk management built entirely around longevity, survival. You should never, ever risk more on a single idea than what could be considered almost disposable relative to your total capital base. Typically, that means risking just 1%. Or at the absolute maximum, maybe 2% of your account equity on any single position.
1 or 2%.
That's it. This isn't really about being safe or timid. It's about respecting the brutal mathematics of compounding losses.
Okay, but I can hear the objection already, right? Why settle for risking only 1%? The potential reward seems so small on each trade. This conservative approach, it feels too slow, maybe too boring for someone who's trying to replace their income or get rich.
And that perceived slowness, that is the entire point. That's the feature, not the bug.
Oh, okay.
The market seems almost designed to reward patience and systemic thinking, not constant excitement or adrenaline rushes. Let's actually dive into the mathematical reality here because it's pretty stark and it's what destroys accounts.
Okay, let's get mathematical. Show us the real difference in outcome between risking, say, 20% per trade versus sticking to that 1% rule.
Right. Let's consider the math of drawdowns and the required recovery percentages. This is almost universally misunderstood by beginners. If you risk 20% per trade and you suffer just 4 consecutive losses, which happens all the time, even to market wizards, believe me, your account isn't down 80% of the loss amount.
No.
No, your account value is down about 60% after 4 20% losses on remaining capital. Let's recalculate that. 100 minus 80, minus 64, minus 51.2, minus 40.96. So you're down almost 60%. Actually, still devastating. Let's say you hit 5 losses at 20% risk. Then you're down closer to 67%. Let's stick with the 80% drawdown example for simplicity. Even if the math is slightly off, the point remains. Let's assume an 80% drawdown for illustration.
Okay, an 80% drawdown. That sounds devastating.
It is devastating. Because the math of recovery is nonlinear, it gets exponentially harder the deeper you fall. To recover from an 80% loss, you don't just need an 80% gain on what's left.
You need much more.
You need a staggering 400% return on your remaining capital just to get back to where you started, to break even. Think about that. You've essentially moved from having a trading problem to having a virtually impossible structural problem. You're likely emotionally broken, your confidence is shot, and now you have to achieve a return 5 times larger than your loss, just to get back to zero. It's almost insurmountable for most.
That explains perfectly why the vast majority never recover from big drawdowns. They get stuck in that deep hole.
Exactly. Now, contrast that nightmare scenario with the disciplined speculator. The one who religiously adheres to the 1% risk rule. That person can endure 10 consecutive, absolutely horrible losses, a truly brutal losing streak, and how much are they down?
10%, roughly. A bit less due to compounding on smaller amounts.
Right, around 10% of their starting capital.
Yeah.
Now, to recover from that 10% loss, what kind of return do they need on the remaining capital?
Just over 11%.
Precisely. Around 11%. That's achievable. It's manageable. They live to trade another day. Their confidence is probably shaken, sure, but it's not destroyed. And critically, they maintain the mathematical runway needed for eventual success. They can keep trading their system.
So the core rule is crystal clear then. Preservation of capital isn't just important, it's rule number 1, and maybe rule number 2 as well.
Absolutely. All the complex indicators, the fancy analysis techniques, the news watching, all of it is completely secondary to surviving the inevitable rough patches. You have to stay in the game. The market, fundamentally, is just a mechanism. It efficiently transfers wealth from the impatient and the mathematically foolish.
To the patient and the wise.
To the patient and the mathematically disciplined. Those who ignore the basic math because they crave excitement will always, always provide the liquidity and the profits for those who stick to the discipline.
And that desire for excitement, for constant engagement, that leads us directly into fatal error number 2, overtrading. The addiction to action, as you called it.
Yes. The beginner often suffers from what you could call the slot machine mentality. They have this ingrained belief that the number of times they pull the lever, the number of trades they make, directly correlates to their potential profit.
More trades equals more money.
That's the flawed assumption. They want to be in the market constantly. They feel that if they're sitting on the sidelines in cash, they're somehow missing out on guaranteed gains. That feeling, that FOMO, is profoundly destructive.
But let's play devil's advocate. For someone trying to do this full-time, maybe professionally, how do they justify sitting out, sitting in cash for weeks, maybe even months? If their income theoretically depends on execution, how do they manage those long periods of inactivity?
That is the critical test of professionalism, isn't it?
Yeah.
Understanding this. The really big money, the life-changing money in speculation, is generally not made in the constant buying or the selling.
Where is it made then?
Fundamentally, it's made in the waiting.
In the waiting.
Yes. Professionals understand that high probability setups the trades that offer truly asymmetric risk-reward, where the potential gain vastly outweighs the calculated risk. Those only occur when very specific structural conditions align in the market. They will happily wait, sometimes for weeks, sometimes for months, incurring zero trading costs, zero stress, until the setup is just right, until it meets all their strict criteria. Meanwhile, the amateur is constantly churning their account.
Racking up commissions, slippage.
Exactly. Racking up transaction costs, accumulating psychological stress from minor wins and losses, and ultimately achieving mediocre, or usually negative, returns during that same period the professional was patiently waiting.
So the patient trader is essentially waiting for the mountain to come to them, while the overtrader is frantically chasing every little hill they see.
That's a perfect analogy. Exactly. And this addiction to action, it almost guarantees poor judgment over time. It forces a trader to take marginal setups, trades they know aren't A-plus flocky. It makes them emotional, reactive, and eventually, often, desperate.
And desperation is poison in the market.
Absolute poison. When a trader is desperate to make back a loss, desperate to hit some arbitrary monthly income target, they lose all objective reasoning. All discipline goes out the window. And the market, well, the market seems to sense that desperation like a shark senses blood in the water, and it feeds on it.
Okay, let's shift focus now from the math and the actions to the internal enemy. Because it really seems like the market is perfectly designed to exploit our inherent psychological weaknesses. You made a really interesting distinction earlier between a loss being taken and a loss being ignored. Can you expand on that?
Yes, a loss that is taken quickly, decisively, and adheres to your predefined risk rule, that 1% or 2% you decided on before entering the trade. That loss is essentially a non-event.
Just cost of doing business.
Precisely. It should be forgotten almost overnight. It's simply the operational cost of speculating. But being wrong on a trade idea and then emotionally refusing to accept that fact, clinging to the position, ignoring the mounting loss, hoping it reverses, that is what inflicts grievous damage.
Damage beyond just the account balance.
Oh, absolutely. It damages the pocketbook, obviously, but it also deeply damages the trader's soul, their psychological capital, their ability to execute rationally on the next trade and the one after that.
This sounds exactly like the classic ego trap we hear about. The moment the market turns against their position, the trader stops being a rational risk manager.
And starts trying to prove the market wrong. They take it personally, like it's an affront to their intelligence or their analysis.
Yeah.
And that is the core mistake that really defines the 90% who fail. They take a small, manageable, acceptable loss, let's say, 50 points against them on a stock position, and instead of just cutting it cleanly, their ego screams, "No, I can't be wrong." It refuses to concede the mistake. So they hold, they hope, they pray maybe. The loss then doubles, then it triples. That manageable little mistake metastasizes into a genuine catastrophe for their account.
And often they make it even worse, right?
Oh yeah. Worse yet, they often engage in the truly catastrophic action of throwing good money after bad. They average down, doubling, tripling down on the losing position to lower their average entry cost.
Which is basically just an attempt to escape the psychological pain of admitting the initial error by digging an even deeper hole.
It's the ultimate bankruptcy of pride. You have to remember, the market has absolutely zero interest in validating your intelligence or your forecast. It simply reflects the collective action, the net buying and selling pressure of all participants. When the price action the tape tells you you're wrong, you must separate your personal feelings, your ego, from your portfolio management. As the old wisdom goes, pride goeth before the fall.
And in the market, pride will bankrupt you faster than any bad trade ever could.
That's the one. Faster than any bad trade.
And the tragic irony, the contrast here, is that the very same person who refuses to cut a small loss quickly, they often do the exact opposite when they finally do have a winning trade, right? They snatch at tiny profits.
Oh, it's textbook. This is a well-documented cognitive bias called the disposition effect. It's incredibly common. Traders rush, almost instinctively, to sell their winning positions way too quickly. Why? To secure the immediate psychological satisfaction, the relief of booking any gain, even a tiny one.
And in doing so,
They consistently cut off moves that could have potentially netted them 5 times, 10 times the profit they took. They're terrified the market will take back the profit they have on paper. So they prioritize the certainty of a small, immediate win over the uncertainty of holding for a potentially much larger one.
So they grab, say, 20 pips, feel proud and relieved for a moment, and then watch in agony as the position they just closed runs another 200 pips without them.
Every single time. It happens constantly. They've completely reversed the fundamental equation for success in speculation. What they end up doing is achieving small, frequent psychological rewards. Those little wins feel good while simultaneously exposing themselves to infrequent but massive, potentially account-destroying risks by refusing to cut their losses.
When the actual rule is the opposite.
The rule, the mantra, has always been, cut your losses short and let your profits run. But our basic human nature, our psychological wiring, seems biologically programmed to fight that simple rule at every single turn.
So it sounds like the biggest enemy in this entire business isn't a surprise interest rate hike or a black swan event or market crash. It's the person looking back at you in the mirror.
Without a doubt.
You identified 3 specific destroyers, the emotional culprits that guarantee self-sabotage, fear, greed, and hope.
Yes, those three emotions, fear, greed, and hope, they're essentially our evolutionary instincts. They served us incredibly well out on the savannah, helping us survive immediate physical threats.
But not so well in the market.
Profoundly maladapted for the modern financial market, which operates on probabilities, patience, and emotional detachment, things that don't come naturally.
Okay, let's break down how each one works against us in real-time trading. Start with fear.
Okay, fear. Fear is what causes you to exit good trades, winning trades, far too early. You have a position, it's up a modest amount, maybe it pulls back just slightly, and fear instantly triggers panic. It whispers in your ear, take the money now before it disappears. So you sell. You lock in that small win. And then inevitably, you watch the stock or currency resume its strong climb, leaving you behind. You avoided a tiny bit of potential pain maybe, but you sacrificed a massive potential gain.
Okay. Then there's its counterpart, greed.
Right. Greed works in a couple ways. It's often what makes you hold on to bad trades for too long, hoping they'll come back. But equally damaging, it makes you hold on to good trades way past the point of wisdom. Let's say you're up significantly, maybe 200 pips on a Forex trade. Greed kicks in and says, this is amazing, it's definitely going to 500 pips, don't sell yet. You start ignoring clear technical signs that the market is getting exhausted, maybe showing divergence. You fail to trail your stop loss up to protect your gains. And when the inevitable reversal finally hits hard, you hold on. Why? Because the thought of giving back even a fraction of that accrued paper profit feels too painful.
So greed turns a winner into less, or even a loser.
Exactly. You let a potentially massive winner turn back into a small profit, or sometimes, catastrophically, greed lets it turn all the way back into a loss because you just couldn't let go near the top.
And finally, the third one, hope, which you said seems the most insidious. Why?
Hope. Hope is perhaps the most toxic element, specifically when you're in a losing trade. When the market has clearly, objectively, definitively told you that your initial trade idea was wrong, the price is moving strongly against you. Hope is that little voice inside that keeps reassuring you.
Just hold on a little longer.
Just hold on, it has to turn around eventually. It's oversold now, it must bounce. It's the emotion that encourages you to believe the impossible, to suspend all rational analysis, all your risk control rules. You stop trading the market and start trading based on a desperate psychological need for vindication, for your initial idea to be proven right. Hope kills accounts.
So if fear makes you sell winners too soon, greed makes you hold losers too long, or winners too long, and hope keeps you in losing trades indefinitely. What you're really saying is that successful speculation requires doing something completely unnatural, acting precisely against every hardwired human impulse.
Essentially, yes. It rewards what feels unnatural. You have to find a way to hold on to a position when fear is screaming at you to sell. You have to find the discipline to sell or take partial profits when greed is urging you to hold on for more. And most importantly, you have to cut loose immediately, without hesitation, when hope starts whispering reassurances about a trade that's clearly gone bad. The ability to consistently execute the disciplined, rational action when your primal lizard brain is screaming the opposite. That, I believe, is the fundamental dividing line between the losing 90% and the consistently profitable 10%.
Okay, let's move from mastering the internal game to looking at external strategy. Assuming we can manage our risk and control our emotions, what's the single simplest principle for actually capturing profits over time? All the classic wisdom seems to point towards just following the path of least resistance, the trend.
Absolutely. If there's one strategic mistake that perpetually bankrupts amateur speculators generation after generation, it's fighting the primary trend.
Trying to be smarter than the market.
Exactly. They try to be clever. They're constantly trying to pick the exact tops in an uptrend or the exact bottoms in a downtrend. That is truly a fool's game. It might give you momentary bragging rights if you get lucky once.
But it ensures long-term failure.
It ensures long-term capital destruction. It's just not a sustainable way to trade.
Because the great fortunes, historically, weren't made by pinpointing those reversal points, right? They were made by riding the big moves.
Precisely. The foundational wealth generated in markets, historically, was largely created by speculators who had the vision and the patience to recognize a major market movement, a primary trend that might last for months, sometimes even years, and they simply positioned themselves accordingly and rode it. When the market was clearly, undeniably in an uptrend, they went long and they stayed long. They added on dips. When the primary trend eventually shifted downwards, they got out and maybe went short. It's about letting the market do the heavy lifting for you, letting it carry you, rather than trying to constantly fight it or direct it.
The modern mentality, though, especially maybe fueled by social media and instant news, seems to breed a kind of aggressive arrogance, doesn't it? We see every little dip as an immediate buy the dip opportunity, believing we're smarter or faster than the overall market force.
Yes, and that arrogance is incredibly costly. Today's traders, especially newer ones, they see a strong multi-week downtrend in a stock or an index, and their first instinct is often, oh, it must be oversold now, I'll be the hero and buy this dip.
Trying to catch the falling knife.
They are absolutely trying to catch a falling knife, hoping against hope they've miraculously timed the exact bottom tick. Instead of waiting patiently for clear, confirming evidence that the trend has actually reversed, they jump in prematurely. They fail to internalize that old saying, the trend is your friend.
Until it ends.
Right, until the bend at the end. But you have to know how to identify when that friendship is actually over, when the bend is happening.
So how does the trend signal its end then? If we're supposed to ride it but not fight it, what are the key signs? What does a disciplined speculator watch for to know when it's time to get off the train?
Well, the market usually will signal the end of a primary trend fairly clearly, but only if you're looking at the right signals, the right data points, and not getting lost in the day-to-day noise or opinions.
Okay, like what kind of signals?
You look for a definitive breakdown of key long-term structural support levels in an uptrend or resistance levels in a downtrend. You look for potential divergences, maybe prices making a new high, but momentum indicators like RSI or MACD are failing to confirm, making lower highs. That's a warning sign. Crucially, you often look at volume. Does volume dry up significantly during the final advances of an uptrend? That suggests lack of conviction. Or conversely, do you see a massive spike in volume during a sharp reversal, indicating capitulation or strong selling pressure?
So it's about a change in the market's underlying structure.
Exactly. The end of a major trend is usually marked by clear change in the market's character and structure, often involving increased volatility and a shift in leadership, not just a single bad day or a minor wobble. It takes time to turn an aircraft carrier.
It sounds so elegantly simple when you put it like that. Follow the trend, watch for signs of its end. Yet we humans seem determined to overcomplicate everything with dozens of indicators, complex models. Which brings us back, maybe one last time, to the core mathematics of failure versus the mathematics of survival.
It really does boil down to math, doesn't it? It's almost a mathematical certainty over a large number of trades. The winners, the survivors, consistently adhere to the simple equation. Keep your losses small and let your profits become large when you're right. The losers, the 90%, do the exact opposite, usually without even realizing it consciously. They take small, quick profits, and they allow their losses to become massive. And even if a loser gets incredibly lucky for a short period, maybe they catch one huge speculative rally just right eventually, inevitably, the mathematical law of averages, the negative expectancy of their approach, will catch up with them. Their account, stripped bare by those few catastrophic losses, will be liquidated. The math always wins in the end.
So if there's one absolute rule we should never violate, the one that acts as the ultimate external guide overriding our opinions and forecasts, it has to be never argue with the market itself.
Never argue with the tape. That's the old saying, and it's timeless wisdom. When the price action, which is the objective, impartial reality of the market, clearly tells you that your trade premise, your reason for being in the position is wrong, you must listen immediately. Don't fight it. Don't rationalize. Don't invent reasons why the market is being irrational or why your favorite indicator is right and the price chart is somehow wrong. Just accept the loss, the small, manageable loss you previously defined as acceptable through your 1% or 2% risk rule. Internalize whatever lesson it offers and move on. Detach and look for the next high-probability opportunity without emotional baggage.
Now let's try and connect all this enduring, almost ancient historical wisdom to the marketplace we face right now. Technology, instant information, algorithmic trading, they've changed everything about how we execute trades. Does this age-old advice about fear, greed, trend following, risk management, does it actually still hold up today?
It's a great question. The tools have changed dramatically, yes. But the fundamental player, that the human mind operating under uncertainty and pressure, has not changed one bit. If anything, technology has only given us the capability to execute the exact same psychological errors faster, more efficiently, and often with much greater leverage than ever before.
So we can just lose money quicker now.
Essentially, yes. You can now liquidate your entire account in a matter of minutes, maybe even seconds, trading highly leveraged products 24 hours a day. Historically, it might have taken weeks of receiving margin calls through the mail before you were finally forced out. The potential for rapid self-destruction is higher than ever.
And what about the modern influence, particularly of social media? How does that play into these timeless
Oh,
traps?
social media. It's like the ultimate accelerant for selective memory and trader arrogance. It creates this incredibly powerful, pervasive illusion that high-risk, high-reward trading is not only possible, but somehow the norm.
You only see the wins.
You only see the highlight reels, the screenshots of the 500% gain on a meme stock, the picture of the new Lamborghini supposedly bought with trading profits. You never see the thousands of accounts being wiped out daily behind the scenes. You never see the years of grinding, painstaking discipline, small losses, and patient waiting that almost always preceded any genuine, sustainable success story. It massively reinforces the gambling mentality, prioritizing excitement, big bets, and instant results over discipline, process, and long-term survival.
So the human element, our innate tendencies towards fear, greed, hope, ego that remains absolutely constant. We just keep repeating the same predictable mistakes generation after generation, maybe just with faster tools now. And to join that elusive minority, the 10%, you have to consciously, actively choose to behave in a way that feels completely unnatural.
That really is the summation of it all. Money in the markets consistently flows from the many to the few. It flows from the impatient to the patient. And it flows, most importantly, from the emotionally driven to the coldly rational and disciplined. The market is not really a meritocracy based on raw intelligence or clever forecasting. It's much more of a disciplinocracy based purely on self-control and adherence to sound principles.
So wrapping this up, what does this whole deep dive mean for you, the listener, the learner out there who's trying to cross that incredibly difficult threshold, trying to get into that surviving, thriving 10%?
I think it means, first and foremost, accepting the absolute inevitability of losses. They are guaranteed. They are part of the process. You will face them frequently. The core question isn't if you will lose money on trades, but whether you have instituted the strict risk management rules, the non-negotiable discipline necessary to learn from those losses without being destroyed by them. Can you survive long enough to apply the wisdom you gain? Only by truly respecting the market's power, its impartiality, and most critically, by controlling your own internal emotional responses, can you even hope to join the small minority who consistently prosper over the long run. Think of it this way. The market is an incredibly expensive teacher, right? And the brutal truth is, most students simply can't afford the full course tuition. They drop out after the first few painful lessons. So the final question for you to contemplate is this. What painful lesson, what ego-bruising truth are you willing to pay for with managed, controlled risk in order to finally graduate and join the 10%? If you want more of this kind of videos, hit that subscribe button now. Thank you.